There's a lie watch collectors tell themselves. Not out loud, not to their partners, not even to their mates at the pub. They whisper it internally like a financial lullaby. It's not a waste of money because it holds value. And that sentence has probably justified more stainless steel than any marketing department ever could. Because when you've just spent $10,000 on something that tells the time worse than your oven, you need it to be strategic, you need it to be sensible, and you need it to be an investment. But here's the uncomfortable truth. For most of us, watches are not investments. What they really are is beautifully engineered, emotional decisions with some resale value attached. And the moment you start calling them assets, something subtle shifts. You stop buying watches and you start buying narratives. Now, before you fire up Chrono24 and type an angry comment about your Daytona, stay with me, because later in this video, I'm going to introduce you to a scenario that may completely destabilize this entire thesis. A scenario where watches genuinely do behave like investments. But here's the catch. It only works if you're playing a very different game, which most of us aren't. So today, we're going to separate romance from reality, hype from mathematics, and collecting from pretending we're portfolio managers with hairy wrists. Let's begin. Now, the watch world didn't always talk like this. 20 years ago, you bought a Submariner because you liked it, or because you wanted to be James Bond. Now, people talk about watches the way crypto bros talk about projects, and that's because three things happened. First, the internet made everything a market. Chrono24, watch charts, YouTube. Suddenly, every watch had a price trajectory, and once you see the graph, you can't unsee it. Second, the pandemic. People stopped traveling, stopped going out, stopped living, and started buying. And third, the big one, brands realized they could weaponize scarcity. Not just scarcity as a natural outcome, but scarcity as a strategy. And collectors, being collectors, indulged. Here's the part people don't like hearing, because it ruins the fantasy. Watches didn't become investments because they suddenly gained intrinsic value. They became investments because the market went a bit feral, like hyenas gate-crashing a golden retriever's birthday party, or Wall Street discovering Pokemon cards. Between 2020 and 2022, the secondary market surged, especially for Rolex sports models, AP Royal Oaks and Patek Nautilus references. Prices inflated fast, and then reality returned. One of the clearest ways to see this is with the watch chart's overall market index, which peaked around early 2022 and then fell significantly across late 2022 and then 2023. That's not a stable asset. That's a mood swing. And if you want an even more brutal example, the Bloomberg Subdial Watch Index, which tracks the value of the 50 most traded watches, also peaked around 2022 and dropped sharply afterwards, which is the key point. Investments don't behave like vibes, but watches do, because watch value isn't tied to productivity or dividends or output. It's tied to cultural desire, and cultural desire is basically vibes with a credit limit. Now, a watch doesn't hold value because it's steel. Steel's cheap. A watch holds value because a large enough crowd has collectively agreed that this particular chunk of metal is desirable. That's it. That's the whole trick. And that's why watch investing is fundamentally unstable, because it's not an asset class. It's more like social consensus, and social consensus changes faster than Rolex can release another green dial. This is where it gets interesting, because most collectors don't start as investors. They start as romantics. But the investment mindset creeps in stages. Level 1, it's safe. This is the date-just logic, where they say, if I like it, if I ever need to sell it, I won't lose too much. Fair enough. That's not investing. That's comfort. Level 2, it's liquid. This is the Submariner logic. It's basically cash on the wrist. which is not true. But it's the kind of lie we all enjoy. Level 3, it will go up. This is the Daytona logic. Now we've crossed the line because you're no longer buying a watch. You're buying a story about demand, and the story is the thing you're actually paying for. Level 4, it's a legacy asset. This is the Nautilus Royal Oak logic. This is where people start acting like a stainless steel bracelet watch is a family heirloom that belongs in a vault beside gold bars and old war medals. It's not. It's a watch. A very nice watch, but still an overpriced hunk of stainless steel. The Daytona is no longer a chronograph. It's a financial instrument. You don't buy it because you love timing laps. You buy it because it signals access, status, and scarcity. And in the modern market, scarcity isn't a side effect. It's the product. Rolex could sell more Daytonas if it wanted to. And yes, Rolex has publicly stated it's expanding production with new facilities, but here's the thing. Rolex doesn't just sell watches. Rolex sells control. And if you flood the market, you lose the mystique. So the Daytona becomes what it is now, a trophy you win by being a valued customer or by paying the grey market tax, which is just another way of saying you're paying extra for the privilege of skipping the humiliation. Here's where the investment myth reaches its most ridiculous form. A Patek Nautilus in stainless steel can cost more than many solid gold watches. Think about how insane that is. Not because Patek isn't brilliant, not because the finishing isn't excellent, but because the materials do not justify the price. And that's the point. The price is not about materials. It's about belief. It's about cultural consensus. And it's about the idea that owning this means that you've arrived, which is one of the most dangerous lies humans tell themselves. Because arriving isn't real. It's a horizon line. You walk toward it your whole life, and it just moves further and further away. It's simply part of the human condition. Now, before we go any further, I need to admit something. I met a man recently in Bangkok who made me question this entire video, and I'm going to change his name here because I'm not here to stitch him up for the sake of content. Let's call him Peter. He's Danish, he's wealthy, and he is, in every sense of the word, a proper watch degenerate. Not the normal kind, not the I bought a Tudor and now I own a watch roll kind. He's the kind who has a relationship with his authorized dealer so strong, so established, so absurdly VIP, that he lives in a different watch economy to the rest of us. Peter doesn't walk into a boutique and get told to wait. Peter walks into a boutique and gets told, welcome back. And then, quietly, without fuss, the good stuff appears, the rare stuff, the stuff normal collectors spend 5 years writing forum posts about. He owns half a dozen IWC pieces, including the sort of big pilot you don't just stumble across unless you're famous, connected, or secretly running the brand. He owns multiple Rolex pieces, including not one, but 2 Daytonas. And then he told me something that made my jaw detach from my face. He bought a Cartier tank for about £1,500. Not because it was fake, not because it was broken, not because it fell off the back of a tuk-tuk, because he had such a strong history with his authorized dealer back home, and he stacks that relationship with something else most collectors never even factor in. Tax efficiency, VAT refunds, cross-border buying advantages. Peter doesn't just buy watches, he buys watches with leverage. He buys watches with discounts most of us would assume were mythical. And he told me casually, like he was ordering a coffee, that in some cases he's paid the equivalent of 25% of retail, which is staggering. Now, if you're listening to this and thinking, wait, so watches can be investments? Yes, under the right circumstances. But here's the important part. Peter is not proof that watches are investments. Peter is proof that access is the investment, because what he's doing isn't watch investing. It's not speculation. It's not flipping. It's not buying the dip or even market timing. It's being positioned upstream. Peter isn't playing the same game as the rest of us. He's not buying watches inside the consumer market. He's buying watches before they become consumer market objects. And that changes everything. Because once you can buy rare watches at retail, with discounts and tax advantages, you don't need the watch to go up. You're already up. You're already winning. The profit isn't in the steel. It isn't in the movement. It isn't even in the brand. The profit is in proximity. Proximity to the supply chain, proximity to the dealer, and proximity to the gatekeepers. And the moment you understand that, you realize something a bit uncomfortable. Watches don't become investments when they become valuable. They become investments when you become privileged enough to buy them the way the system intended, which is not how most collectors buy watches. Most collectors buy watches like civilians. They buy retail, they buy grey, they buy second-hand, and they also buy on a whim and because they had a bad week. Peter buys like an insider, and that's the difference. So yes, for Peter, watches can behave like investments because Peter isn't investing in watches. He's investing in relationships. And the watches are just the reward for being allowed into the room. This is the part that matters, because watches aren't really about time. They're about identity. A Rolex isn't a tool, it's a signal. A Royal Oak isn't a timekeeper, it's a statement. And the fantasy is always the same. If I own this, I will become the version of myself that I've always tried to reach. I will be more confident, more successful, more respected, less anxious, less invisible. And that is deeply human, but it's also deeply exploitable because brands don't sell watches. They sell transformation. They sell you on you, but the upgraded version of yourself. And we, being emotionally fragile mammals, usually eat it up. Let's get brutally practical for a second. Even if your watch holds value, you're still paying for servicing, insurance, wear and tear, transaction fees, time, hassle selling, and the constant mental noise of what is it worth now? And that last one is the killer, because once you start thinking like an investor, you stop wearing the watch like a human being. You start wearing it like an asset. You stop enjoying scratches. You stop enjoying life. You start becoming the sort of person who says things like, I'm not wearing it today because it's windy. And here's a financial grenade in the room. If watches were truly investments, the average person would be outperforming the stock market by buying luxury jewelry. And that simply isn't happening. Because if you bought at the top of the hype in 2021 or early 2022, a lot of those can't miss pieces are now down, sometimes dramatically. Not because the watches got worse, but because the mood changed. If you want something that grows wealth over time, buy an index fund, buy a property, buy something boring, something regulated, something that doesn't depend on whether Gen Z suddenly decides that dive watches are cringe, because that's the real risk with watches. Not theft, not servicing or scratches. It's cultural irrelevance, and it happens faster than people think. So, are watches investments? No, not in the way people mean it. Some watches can hold value, some can rise, some can explode in price, but that isn't investing. That's luck meeting hype. In a culturally inflated moment, watches are not built to make you rich. They're built to make you feel. And honestly, that's enough. Just be honest about what you're buying. Because if you treat your watch like a portfolio, you'll wake up one day and realize you didn't collect timepieces. You collected anxiety. Buy watches you love. Wear them. Scratch them. Let them live. And if they go up in value, great. But don't build your happiness on it. Because markets don't care about you. And your watch doesn't either.